about how quickly you'd be able to proliferate that throughout the world with Bitcoin as part of the infrastructure.
Yeah, I'm open to the idea of using Bitcoin. I mean, it's like I said, it's of the various things that I think about Bitcoin very little. But I've thought about monetary systems a lot and the actual practicalities of exchanging money, or money is really just data, information in a database. And it basically, money is an information system for labor allocation. So, but most people think of money as having power in and of itself, but you can obviously run some basic thought experiments and say, if you have $8 trillion on it, and you're marooned on an island, it's useless because there's no labor to allocate. You only once you have some complexity and, you have people with different skills, then you need sort of an information system for labor allocation and to shift obligations across time. But it's remarkable how many people think money has power in and of itself, because that is their experience, certainly in any advanced economy. For example, if you were to say, like, let's spend more money on healthcare, I'm like, okay, well, you can't instantaneously change the number of doctors. Doctors take roughly 30 years to, for a new doctor, a baby to be born and ultimately to be educated and become a doctor. You can't just throw money at a system and suddenly have, get doctors from a magic doctor factory. So you can over time change the number of doctors if you change the incentive structure for doctors, but you cannot, just adding money to a system does not create more doctors. But people weirdly sometimes think that is the case, because they see what is immediately in front of them, but they do not see two or three layers deep. In fact, this is why inflation is such an effective means of taxation, is because inflation is a few layers deep, and most people simply see one or two layers deep. But so if something is like 3 layers away, that they simply don't realize it, and they will in fact be angry at the store for the prices going up, even though it is in fact the government that has caused the prices to go up.
That's why we have to get the government out, right?
Yeah.
Right.
For any given system, whatever the incentive structure is, whatever the incentives are, that's what will happen. And then it should be no surprise if you incent something that it will happen. It would be weird if you incent something and it didn't happen.
In the context of your companies, Elon, SpaceX, and Tesla, what was the rationale behind using Bitcoin in the treasury? And is it something that you've kind of backed off of, or is it something that you're amenable to kind of more broadly?
Well, I mean, we did make some prominent purchases of Bitcoin. At Tesla, we just became a bit concerned that the big changes in the ratio of dollars to Bitcoins, that value ratio was changing too much, and in case we needed the working capital, it would be better for us not to have a Bitcoin. And now SpaceX still has most of its Bitcoin because SpaceX did not anticipate any working capital issues, potential working capital risks. And, and I was at one point, it really seemed like the use of electricity for Bitcoin was on the margins, really being quite a lot of dirty electricity. And I know people have got all these, rebuttals to high CO2 energy being used for Bitcoin. But there was at one point, I think an entire power station and coal mine in China that was a truly gigantic one that was responsible for a massive amount of Bitcoin mining. Now, I believe that has now been shut down, but I think that actually constituted some insane amount of Bitcoin hashing at one point. I think things have gotten better with just usage for Bitcoin hashing. It's still a little bit of a concern, but it seems to be not as serious of a concern as it was in the past.
That's analogous to me arguing that electric vehicles are bad because they're powered by a coal power plant. I think you have to divorce the source of the electricity from the actual fundamental good that's spending energy to secure the Bitcoin network produce. Here's a currency that a government can't control. It can't control because you have basically a decentralized distributed denial of service system preventing it from being kind of controlled and co-opted. And the cost of that is the energy use then.
I don't think they were exactly, in this case of the gigantic coal mine and coal power plant in China, its sole purpose was Bitcoin mining. And it was really not something that would be used for anything other than Bitcoin mining. In fact, when that plant went offline, there was a massive drop in hashes per second for Bitcoin. That's how you could tell it was that plant. It's when that was problematic. It went too far at a certain point. Now, like I said, I think at this point it is better. And when you look at electricity usage, when it's not being pushed beyond reasonable bounds, it is electricity production is increasingly sustainable, coming from wind and solar with buffering, with battery pack buffering.
Elon, if you don't back the monetary units with work, something that actually takes energy, as opposed to keystrokes, I just don't know how you can build a better system that actually pegs fiat currency around the world without some type of proof of work mechanism.
No, I'm not saying you couldn't have some proof of work mechanism. I'm just saying that, and look, I don't want to, I'm on this call because Kathy asked me to be on this call, not because I'm wish to argue about it.
I still do think that this is an important.
If we're getting annoying Bitcoin arguments, I'll sign off.
I think, Elon, you kind of raising some of these concerns, I think is part of the education process for understanding Bitcoin. This is exactly why we have these conversations. We don't necessarily need to go back and forth, but maybe I see Harry's actually on the line. He is a Bitcoin miner, perhaps kind of setting up the case for just energy in Bitcoin and how you're effectively converting electricity into a hard asset for perhaps might help as a framing.
Hey, Yassine, thanks. Great to be here. Congratulations, Kathy, the entire ARC team. We've actually been through our own SEC process in the last 2 or 3 weeks as well, and got approval to take Grid public. So
congratulations.
Thank you. We're in good company with you, to say the least. I want to address just the energy thing in general, because I actually think Elon sort of is right about the more fundamental heuristic, which is that Bitcoin provides a revenue stream to energy generation assets that they wouldn't have otherwise. And so on the one hand, that can create, perverse negative dynamics and externalities when it comes to a one-off coal plant or several one-off coal plants that are getting shuttered, whether regulatorily or financially, and can breathe a second life into assets that maybe, we as a species would argue against. I think that's true. And I think that's negative. I think that the positive as a totally orthogonal purchaser of energy actually carries the positive day net, because there's an enormous amount of opportunity. If you look at the interconnect pipeline in the US, for example, there are wind and solar farms that are waiting multiple years just to connect to the power grids to be able to enter their renewable energies into our markets. And they're unable to, whether for regulatory reasons or system engineering reasons. And so you're able to bring a Bitcoin mine to that generation asset and start clicking revenue much earlier. It means that the ability to finance these projects is significantly expanded. It means that the infrastructure costs that get passed back to ratepayers get to be lower because those revenues get brought to market much sooner. And it does a lot less from an eminent domain. Where do you bring the lines? Those types of environmental and regional issues, those all get diminished as well. The only other thing I just want to add and shout out is just that this is not a US story. This is a global story. And there are places all over the world that desperately need enormously more electricity. And so we believe, and there are companies out there like Eric Hirschman and Gridless Compute, who are bringing net new electricity on a clean hydroelectric basis to communities that desperately need it. They're taking kerosene offline, they're taking hydroelectric online, and they're doing so on the back of proof of work in Bitcoin. And so we're enormously excited about what Bitcoin means as a bootstrapping mechanism for more clean electricity for more people on the planet.
Can I just say for a second that I think Elon's points should be taken very seriously? The electricity argument is a detailed argument there, but the existence of Bitcoin, the limitations of Bitcoin, the programming of Bitcoin are the wonders of this coin, and really will be served the whole monetary system of the world. Now, the transactional nature of a Bitcoin is also true, but it's the same thing in gold. What you had here is the Bitcoin will be the reserves, if you will, of a transactional system that will include other entities with Bitcoin like a reserves in the bank. That's where it's really going to go, Elon. And I think you're totally correct that the electricity is a sideshow to this, and the transactional developments that will occur are really where we'll get a new world money. But the Bitcoin is the monetary base, if you will, of that, just like gold used to be.
Art actually wrote a really great research paper a number of years ago around Bitcoin ability to fund clean energy, like Harry was talking to, that I would encourage people to go look up. In fact, Tesla was a part of helping bring pilot plant to demonstrate that and how Bitcoin can help fund solar energy using some of their battery technology.
Who wrote that, Matt?
ARC did, in fact.
We did with Block.
Oh, ARC. Oh, the one we did. Oh, yes. 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 And Elon, this was we did remember with Jack Dorsey, we did the B word. It was called the B word. It was a 5-hour seminar that you, Jack, and I think Steve Lee kicked off. And we spent a lot of time talking about this use case. I actually have one question. I don't know how much time you have, Elon, but I would love to know. You've been clear about the need for us to be an interplanetary species. What money would you use on Mars?
It probably would make sense to use some kind of cryptocurrency on Mars. Now, you couldn't use Bitcoin because the reconciliation time is too long. Like Mars at times Mars can be like 20 light minutes away. Not an easy thing. Difficult. There have to be some localized thing on Mars.
Yeah. So I know some very important movers and shakers in the community are here. I'm sure they are already thinking about ways to make sure that Bitcoin makes its way to Mars. I'm positive.
Yeah, it's just like I said. At times when Mars is on the other side of the sun. I mean, reasonable. A sort of rough way to think about it is there's 8 light minutes from the sun. Mars is roughly 1.5 times as far away from the sun as the Earth. And so at times you're on the order of 20 minutes, but sometimes even you can't go right through the sun. So you have to be bank shot past the sun. So they might be like 23 minutes at max speed of light. Anyway, so I was thinking you could perhaps use Bitcoin to some degree, but it'd be difficult to use it a lot.
Luckily, some of the other technologies like Lightning would work totally great without latency. You'd have to have a localized Lightning network like you were talking about. Now, you wouldn't be able to mine on Mars. You get split mining across the Earth and Mars, but
correct. I think Mars would have something local. I mean, that I hope we have that problem to deal with. If we have that problem to deal with, then really civilization has advanced dramatically. So right now, we've not yet been able to put a single person on Mars. Just a few robots at extremely high prices. So in order to have in order to pass one of the Fermi great filters, which is, are you a one planet species or a multi-planet species? We have to have a self-sustaining civilization on Mars, where the acid test being, if the resupply ships from Earth stop coming for any reason whatsoever, that the city on Mars does not die out.
Well, I want to thank you, Elon. I know if you want to hang out and continue with the coin conversation.
Or you could, yes. Kathy, you're back.
Yeah, did I get cut out? I don't know what happened there.
For just a second.
Okay, what I was saying is I don't know how much time. I mean, I'd love to keep batting back and forth. Bitcoin, I know your time was short, but I wanted to thank you for joining us. This has been awesome. Spaces is awesome, and we're going to be doing a lot more on Spaces. So thank you.
All right. Sounds good. Good. Just
great. Thank you. Okay, guest appearance. He's pretty amazing, but I think we scored a few Bitcoin points there, guys. I think we're bringing him back into the fold. So
I think this is a very similar pattern as to what happened over the last 10 years will probably repeat itself. A huge reason of why we've been able to list these in other jurisdictions with other skeptical regulators, and the same reason that we've been able to do it in the United States, is it's becoming way too big to ignore. Mm-hmm. I think if you just look at ownership levels, the estimates I've seen are anywhere between 15 and 25% of American adults. There's 100 million or more Coinbase accounts, and so on. And so I think a considerable part of this is that it's just becoming much larger impossible to ignore. And that's going to continue to push adoption, in my opinion.
We're going to go pretty soon.
Yeah, we should. Obviously, a lot of people have joined us just recently, and we should just say, obviously, we want to thank the guests we've had so far. We're gathered here today, and they're on with us to really highlight the fact that it's a monumental day with the approval of the Bitcoin ETFs and ARKB for the ARK21 shares Bitcoin ETF launching tomorrow. And these become very relevant conversations very fast for so many. It's the reason that the tagline for the ARC21 shares Bitcoin ETF is, aren't you a little bit curious? There's so much to be curious about for so many who, as I think Brett said earlier, previously had almost excuses not to pay attention. And so we want to bring high quality content. We thank Elon certainly and many others, because curiosity will lead to so much knowledge, and there's still so much debate and so much innovation to go.
Thank you, Tom. I wanted to just get quickly back to finishing up something that I think we started talking about, using the gold ETF. And I know that a lot of people on this call think about inflation, and as I do all the time, risks and so forth. But back then, what was Russian default, long-term capital, Y2K, then the tech and telecom bust, the Fed just kept easing, even though that recession was very narrowly focused. And I think that's what greased the skids for gold and all other commodity prices in the early 2000s. So, when people do use gold, the gold ETF as a guide, I think gold actually might have gone down as a relative to other commodities. And then we were going to go somewhere with that, Yassine. I've forgotten where.
Kathy, I'm going to have to take off. Art Laffer here. Thank you very much.
So
Congratulations again on all you've done. You're amazing. All of you, the whole team.
Thank you, Dr. Laffer, so much for joining. I think that the context was basically trying to find analogies to how, call it, momentous of an occasion an ETF approval is to an asset like Bitcoin, and whether we've seen, similar tipping points in the past.
Well, your research, Yassine, is, I think, very powerful in terms of, getting us to, and people think this is crazy to say that we think Bitcoin could hit 1.5 million by, I think, 2030, or I think it's 2030, which is a 60% annualized increase. But I think our research is sound. And again, it's on Big Ideas for those of you who haven't seen it. The building blocks of getting to that price are not crazy. They're not, they're, and in some cases, they're quite conservative.
That's right. I mean, I think you without even going into the building blocks, if you just apply simple heuristics like taking what the market cap of gold is, which is around $12 trillion, and the market cap of Bitcoin, which is just under $1 trillion. And if you really compare how much better of a version Bitcoin is to gold as this store of value that's portable through.
Yassine, we lost you.
Oh, sorry. I don't know where. I think it just muted. I don't know where
Value. Carry on.
Store of value. And just to think about Bitcoin as being that better version, to think that Bitcoin is not going to reach parity with gold and perhaps even exceed it over the next 10 years, that's an order of magnitude increase from where we are today. So just alone reaching parity with gold brings it to, that $500,000 price per Bitcoin. And then you add on top of that all of the use cases, Kathy, that you mentioned as an insurance policy against arbitrary asset seizure, as this hedge against counterparty risk, really as a remittance network, an economic settlement network, and then, really as an institutional now allocation as a legitimate asset, that getting to that $1.5 million, over the next 10 years seems quite plausible in our view.
Can I just, I want to make sure we had people popping in, so I had meant to do this before, but I mentioned we have Matt with us, Matt Corallo, and Adam Back. I met them at a Bitcoin confab in 2019 in Uruguay. And, here we were getting a lot of flack still for owning Bitcoin. There were some wirehouses, some of the brokerage houses that, made us take GBTC out of some of our funds. Otherwise, they were going to fire us. And, we held firm where we could, ARKW. But my confidence after meeting Matt and Adam shot up dramatically. Core developers, monetary experts, at this conference, really comparing notes, from, young in age to more seasoned in age. I certainly was there. So, but that was for me, like the crowning cap on so much of our our research. It just brought it to life. And I wanted to, thank Matt and Adam.
And for those who don't know Adam, who just joined, he is an OG cypherpunk and invented, I wish he was on to talk about proof of work with Elon, but invented Hashcash, which is really the first proof of work system that was used as that to prevent this attack. So Adam, it's great to have you on. I know that you tweeted a few questions about the ETF approval, and I think that this is actually a platform that we can use to maybe answer those questions and get your thoughts here broadly.
So actually, the technologist is going to with the ETF experts with questions direction, right? Yeah, what I was wondering about is the mechanism by which inflows get into the market, and if the usual T+2 kind of settlement delays mean that market makers or APs run out of capital, which tends to happen from time to time in Bitcoin, in the Bitcoin exchange space. Go ahead.
Yeah, so Ophelia and Amy, our partners at 21 Shares, have built out the infrastructure. Participants, they all do very well with our volatile strategies. And of course, Bitcoin's very volatile as well. And there are lots of arbitrage opportunities popping up now around the world. I mean, 21 Shares has 40 funds. Well, now 46 with this one. And you've also got the underlying asset. So I have witnessed the liquidity in our ETFs is far greater than I would have ever imagined. So Ophelia, maybe you can leverage off of that in terms of what we expect for this Bitcoin ETF.
Yeah. So look, I think one of the things that we can expect to see, and I think this has been a little confusing. So the way these products start trading is you convert the seed numbers you've seen into Bitcoin, and those exist in the products prior to the first day of listing. After you list, you've got market makers who are coming in with orders. Those orders are going to need to be routed typically like through OTC trading desks, partially in order to support some liquidity, and also, quite frankly, partially so that you don't have to take the coins out of cold storage to trade by putting them on an exchange. So we're actually going to be trading out of cold, which is far safer just purely at an infrastructure level. And that's actually true of all of our products. We don't ever have assets that aren't in actual cold wallets. Essentially, the way this is going to end up working is you're going to have these market makers that are making markets, public markets in the security itself. And then on the back of that, they're going to come in and check what their inventory is. If they're short, they're going to create. If they're long, they're going to redeem, so that they're managing their inventory against that creation redemption process. And that's really where you're going to see that trading come in on the crypto side. And fundamentally, the way we approach this is a little bit different. We've taken a very, intense approach to custody and security, and why we have approached it this way, and the kind of technology that we've built over the last 5 years to support it is quite significant. It's not that easy to make an asset like Bitcoin play nicely within traditional financial infrastructure. In order to do that, you need to actually build a bridge between these two asset classes that, they don't share that many features in common. They don't trade on the same rails. They don't settle on the same rails. It's not the same counterparties. It's completely different infrastructure for all the reasons that advisors and investors need the ETF in the first place. That's why it's so difficult to build one.
Did that answer the question? Or I want to make sure that we answer the question precisely. So if we missed the question, please re-ask it. And yeah,
let me make a kind of extremist example, right? So I don't know what people are expecting the first day volume to be, but let's say it's 10 times what's expected. What does that do? Does that mean that, the market makers and APs run out of US dollar liquidity and it becomes difficult to arbitrage and they trade above spot or something like that? Kind of like the GBTC when it was in a premium, but in that case, because it's closed-ended, here just because the market participants run out of liquidity to arbitrage it. In smaller doses, that's what's happened in the past on Bitcoin exchanges.
Short answer is yes, you can see things like that in an ETF, but the difference here is the balance sheets are a lot bigger. And fundamentally, you're running on a essentially T+1 to T+2 structure. And there's a little bit of a gap between when an AP is going or market maker is actually making that market in the public markets and seeing that demand, and when they're going to be able to have those shares on the back end. Unlike GBTC, part of the problem with GBTC is you couldn't create any new units of this product, right? Whereas something like ARKB, from the get-go, you're going to be able to do that. That makes the arbitrage mechanism significantly more effective. You've got that, there's a delta between the creation redemption process running on a T+1 basis versus the actual public markets running on that T+2 basis. And so there is a little bit of time in there in terms of how they're managing inventory and balance sheet. Balance sheets are also quite bluntly just a lot bigger.
Very big. I mean, Jane Street put out its financials, or maybe they leaked. I don't know why they got out. It's an enormous company, enormous companies.
All right. Just always amusing to see Bitcoin break things because volatile and larger than people expect and trades over the weekend and stuff like that. So it'll be fun to observe.
We've actually seen a bunch of that in Europe over the years. You're right. It requires a certain degree of support for APs and market makers that's way beyond what you would expect in an equity market. It also means that, for example, there are a lot of people who might, after hours trade product. And this is a fun little quirk of these ETFs is that, there's this concept of market hours in the US, but there are facilities for after market hours trading. And one of the really interesting things is that unlike an equity product where in your after hours trading, you're kind of guessing at what that price is really going to be based on futures and based on demand in other markets. With this product, you're actually going to be able to price effectively off of an entitlement basis because there's a fixed amount of Bitcoin per share. So they can actually get real pricing and provide actually competitive facilities for after hours trading. And I think that's something we're going to see a lot more of. It's one of the reasons why you see a lot of the big market makers that do work in crypto ETPs and ETFs actually operate on a global basis. And so there's one desk that's globally distributed. And so that will likely also help mitigate some of the things you're talking about. But I do think it's going to be very interesting to see what happens as you start to have, the full force of that demand hit Bitcoin markets. Although I do think it's likely going to take a couple more months than people think to see the full picture in terms of demand.
Does anybody on a kind of analysis side have opinions about the multiple for inflows versus impact on market cap? A few years ago, Bank of America did some analysis indicating it was over 100. I think they had 118. So I'm just kind of curious about what the inflows will turn out to be and what impact that will have on Bitcoin price effectively.
Have done some estimates, actually. That's the power of on-chain analysis. Is you can kind of see which of the Bitcoin is readily available to be absorbed by marginal demand and which one is kind of locked up. And I don't think people fully appreciate kind of the price multiplier effect and that you're not simply just dividing by 21 million and that $1 inflow doesn't necessarily translate to $1 of market cap. In our estimates, when you think about just broader long-term versus short-term holder supply dynamics, about 76% of Bitcoin's supply is held by, what we consider to be long-term holders. So holders that haven't moved their Bitcoin in at least 6 months. And then there's kind of an additional half of that, which is considered short-term holder supply that isn't sort of readily available on liquidity and exchanges. It's kind of just being overturned or turned over at the wallet level. And so if you kind of call it, say, 1 to 2 million Bitcoin of total circulating supply is readily available, there could be to 100, to your point, there's a 100x multiplier. We've estimated it's between a 25 to 50x multiplier for every dollar inflow. But it would be interesting to do some follow-on analysis now that an ETF has been approved.
Yeah, I wonder if the profile of the ETF unit buyers will be different than the active Bitcoin traders. They might be lower velocity buy and hold, whereas the 2 million or so active are, there's leverage and there's day-to-day churn. Whereas I think with ETFs, people are not generally looking to day trade. They're looking to put it in a unit, some other fund, or hold it for some years. So maybe that will
that's it.
As well.
I think that's a great point. Part of what our thesis is that this really opens up or broadens the spectrum of the market for individuals who are looking to buy Bitcoin. I know Tom, our COO, is on the line, but I'd love for Tom, if you want to jump in on just broader advisor market and kind of the demand for something like a Bitcoin ETF relative to traditional spot and how those dynamics are evolving now that we have this approval.
I think some of the discussion has been so binary as an either or. And I think what we're going to find is that's the wrong way to think about it. It's really going to be the percentage of the total allocation exposure that really is allocated between, the to date, what has been the traditional way of doing it, and that part, and this other part that's coming online, this coin ETF. And I think, there are numerous reasons depending on what the buyer's profile looks like. I think one that maybe is something for people to think about, and it depends on unique and individual circumstances, is that while there may be some ways to post the Bitcoin as collateral against a loan to gain personal liquidity, they're not easy for the average person. And so as we get into a regulated, audited security that's custodied at a traditional financial institution, in mostly bank, these securities are going to be able to post as collateral to which, to basically to borrow against. And that borrowing against could be used for any purposes. It could be just increased individual liquidity. It could be reinvested. It could be a number of things. Again, very individual and specific. But I know there are people on this call already who have had exposure to European ETFs and the 21 shares line in Europe, who were able to suddenly gain great personal liquidity without losing the exposure to the investment. And that might not be all of your allocation of Bitcoin. In fact, I would expect it would be perhaps just a small portion. And yet bringing that inside the existing rails of the financial system offers personal benefits as well as potential investment benefits, to continue across the space.
And, that's also realize when we talk about that liquidity, you're talking about standard margin from your bank. It doesn't cost anywhere near as much as what we've seen in terms of some structured loans where maybe you're putting Bitcoin up in order to get cash, right? It looks structurally very different. And it's also, just from a cost perspective, quite different.
I think Kathy made this point earlier, and we really agree with it at 21 shares, which is we have nothing against physical holding of Bitcoin. It just so happens that the ETF wrapper enables a certain set of investors to be able to allocate more in the space or come in at all. And from our perspective, so long as it increases the pie, we're all in. And so it doesn't take away from holding it physically at all. It doesn't take away from any of that, but the ETF does come with very real structural benefits, especially for more institutional investors and more traditional investors.
And I think Brett Whitten earlier said it very well. There's also the incentive structure around allocation to the asset class that the reality is just different when you have an ETF structure than when you've had the coins in traditional wallets or self-custody. And that's because trillions of dollars are tied up in intermediated assets in this country alone. Those intermediaries are certainly not incentivized to lose the fees, or even if it's not fees, lose the oversight and the influence that they have that previously was the case if you had clients leave the closed-walled ecosystem. And certainly, those who are deeply invested in the space correctly will point out that has not stopped them. And they're right. And that's great. But it's also a reality that it has stopped a significant pool of assets. And so, I think it's a very clear, different use case. I also think, I've heard a lot, we've talked a lot about the inclusion effect. In fact, we just had Elon Musk on this Spaces, if you're just joining us. But we saw what happens in the inclusion effect when managers have to pay attention to an asset. Tesla famously was not part of the S&P 500 until it was a huge stock in terms of market cap value. There were a lot of managers.
500 billion, Tom.
$500 billion. A lot of managers conveniently, and you heard it on CNBC and Bloomberg and Vox Business and all of the different places, conveniently got to not have an opinion on a stock that was quite literally changing the world because it wasn't in the index that they benchmarked against. Suddenly, when it was included, they not only had to have an opinion, but they were judged and held accountable for that opinion. And I think that, again, this is not binary. It's not either or, but advisors now have access where their gatekeepers at their custodians or their home offices or their investment had perfect cover to keep it out. They're now going to be accountable as wealth managers for what they say and what they do around this asset. And they know that they're frankly, they're incentivized because even for some of them, they're going to bring some of those assets back under their tent, where it's packaged in the same financial statements, the same tax documents, same, overall correlations, and they're going to put it to work instead. But with these benefits for the client, certainly the cost, and of course, ARKP is 21 basis points. I think compared to what somebody opening a brand new account coming into this asset class for the first time, that's lower than the trading fees. And remember, 21 is the fees all in. That's everything. Whereas, people talk about custody, they sometimes forget about the trading cost. We have to have total cost to total cost when we look at this. And so, things like liquidity, things like the ability to post as collateral are all cherries on top. So that I'm not even talking about the institutions in this country that use about 4 layers of consulting for CYA reasons to protect themselves in a litigious society, who now also have access and are held accountable. So, and those are obviously massive allocations. Even if a small fraction of them do a small percentage, we're talking about a meaningful amount of total capital suddenly coming. So even if you don't believe what I just said for all of it, but you believed one part of it, talking about a significant chunk of institutionalized intermediated wealth. And I understand that's not where the original ethos for Bitcoin was, but I would also say these don't have to fight each other. They can be complementary. And I would be surprised if even those who are the most focused on maintaining their autonomy don't find benefit from at least a small portion of that within the traditional finance system.
Well, also, I mean, not just them, right? I can confidently say I was orange pilled by my mother, which is a shocking thing for most people to realize that's kind of supposed to go the other way. And that happened in early 2014, late 2013. My mom came to me and was like, hey, listen, Merck spends too much money hedging and government's running monetary policy based on geopolitics is stupid. We should have an alternative. Have you heard about a thing called Bitcoin? It's 2014 from my mother, and she missed the trade because of the infrastructure. She didn't feel comfortable setting up an account that was new, that was outside of her financial infrastructure. She totally got the vision. There just wasn't really rails for her to be comfortable with that. So, I mean, honestly, Tom, I would actually challenge you a little bit there, which is it's a little different than the original ethos, but the original ethos is about inclusion, right? We want everyone to participate in this. If you want a few billion users to use Bitcoin, you need to provide it to them in a package that they can actually use and feel excited and confident about. My mom was never going to feel that way.
The inaccessibility of Bitcoin that Ophelia is talking about is very real, and it comes in 2 flavors. One is how she described her mother, or more traditional investors who are just more comfortable with an ETF wrapper. The other thing that we haven't discussed is if we really want this to become so ubiquitous and so world changing, we need to get it in the hands of billions of people. And at least on the institutional investors side, there are a lot of investors out there who have mandates that prohibit them from investing without things like the ETF wrapper. And so both worlds can exist. And if the aim is to increase the market, a great tide will lift all of our boats. We should be working on every single one of these options.
So I think that, it's interesting because on the ARK side, I sat on the other side of the table from 20 shares when we first met to evaluate, what a partnership would look like. And I was struck by the commonality of what the organization's stated mission purpose was relative to the democratization of assets. I mean, I look at the 40 different funds that 21 Shares has in Europe across assets and in the digital asset space, much deeper than what we're currently able to do in the United States due to the regulatory framework, but that I have a high degree of confidence that we will get to. I look at ARK and certainly democratizing using the ETF wrapper, bringing out, a venture fund for mass retail to make private equity available. This Bitcoin very much fits in it. But when we're keeping segments of potential investors out, that's not democratization, right? To truly democratize, it has to be indiscriminatory relative to the individual pain points and friction that any individual may have. And I agree with Haney wholeheartedly that not everyone has the same friction. Not everyone has the same barriers. Some of them are mental. Some of them are psychological. Some of them are financial. Some of them are regulatory. Some of them are legal, but they're very real. And so, when you think about the tagline that we put on this product, aren't you a bit curious? We have to also destigmatize the curiosity versus those of us who have dedicated considerably more time to learning about this in greater depth and say, this vehicle in part is to help overcome the friction points so that you can gain exposure. But also, once you can gain exposure, that is one of the most powerful catalysts. It doesn't matter what we're talking about. The most powerful catalyst for you to spend more time, to be more engaged, and to overcome any real or perceived hurdles that you've had. And I think that is truly what democratization is. I think that the ETF is there. Look, the reality is cost is very regularly a hurdle in almost anything in life. It's one of the reasons why we wanted to have a price, 21, obviously 21. I mean, the price was always hidden in plain sight with the name of the fund, with the partners at 21 shares. But to have it that low is designed, as Kathy said earlier in this call, to reduce absolutely as many barriers and frictions as possible. We're really proud of that. There are certainly bigger named firms that are coming with higher products. They don't necessarily share what we're trying to do here. And that's fine. But you have to understand that with a dedicated mission towards democratization, we're going to talk to all sorts of people who are in all different parts of their crypto journey. And some of them are going to recognize things that we did specifically for those more educated, like what the NAV of this product is going to come out as. And it's pegged directly to the Bitcoin price rather than some arbitrary esoteric price that every other filing has put on this, in a nod that it has utility value. And for the very purposes that we've said before, that the existing ecosystem will find value, but it's also in light of the research, it's calls like this, bringing experts together. And for the advisors out there, if you're listening right now, we intend, and we can personally pledge that we will have the greatest amount of support for advisors. If I were an advisor right now who had not put any clients in this asset class ever before, I know that tomorrow is going to be a very scary day, because my clients are going to call and I might not have all the answers. And honestly, that's okay. And not only is it not okay, it's a good, because that's what a new asset class is. When we're bringing people in who are going to have difficult but exciting conversations that lead to positive outcomes for everybody. And we stand behind you. 21 shares stand behind you. Advisors know that we're partners with Resolute investment managers for the wholesalers and product specialists and support. And what we want is for anyone who's curious at any part of your journey in Bitcoin, we are here from you. And we're extremely proud that ARKB is going to be here for you starting tomorrow.
And people may not realize just how ingrained this is in both of our firms, actually. I remember that one of the things that comfort us the most, one of the things that we were most excited about when we first started to get to know ARK, is the obsession with research that you guys had, the research background that Kathy clearly has, because we think about it the same way. I think it was John Oliver who said, Bitcoin and crypto is sort of like what everyone doesn't understand about encryption and technology combined with what everyone doesn't understand about finance and economics. And they do have a point. As transformed as this technology be, it's incredibly complex. It's challenging. It's difficult. And as a result, from a research perspective, from a learning and teaching perspective, our research team, ARK's research team, this is so central to our identity and what we bring to the table. And so I echo everything that Tom said and agree with him 100%. And we will be providing advisors specifically with the top research in the space, because this is a long-term journey. Crypto is going to be transformative over the next decade, not just over the next month or so. And we're in it for the long haul, and that involves a lot of knowledge and education.
I think that's a good segue to maybe talk about, agree, our commitment to research, but maybe dive into how important sort of paving this new framework to understand Bitcoin as an asset class, understand its fundamentals. You can't apply a discounted cash flow model to Bitcoin like you can to equities. And yet there's so much information that is out there, given the transparency of Bitcoin, given its open source nature, given that, Bitcoin is basically this 24/7 fact sheet of economic behavior in this mini sort of monetary system. And so I thought, we have a new set of speakers that I'm kind of really excited to introduce that have been pioneering a lot of the fundamental analysis of Bitcoin, both through just sharing on-chain analysis, but also, providing that data for the end investor to be able to analyze and understand. And so we actually have Will Clemente, Checkmate on the line, and Pomp as well, who have in some capacity helped really spearhead frameworks to understand Bitcoin fundamentally, which I think is, again, a really important point if we're in the business of also bridging that education gap.
And in the case of Pomp, has been a supporter of both of us for a while, and at least with 21 Co, is one of our earlier investors as well.
Will, Check, Pomp, great to have you guys on. Adam actually asked a question, and maybe this one's for you, Check, and just to introduce, before you answer the question, it would be great to introduce yourself on this almost price multiplier effect of Bitcoin flows and how Bitcoin's, call it liquid versus illiquid supply, plays a big component in trying to understand that price multiplier effect. So perhaps kind of maybe setting up what is on-chain analysis, why that's fundamental to this asset class, how heavily involved, you are, we've collaborated on research together, and then maybe give some kind of statistics on just Bitcoin's economic state would be super helpful for this audience.
Thanks a lot. Thanks for the introduction. Just quickly, let me know if you can hear me okay.
We can hear you.
Excellent. We're in business. So I'm the lead analyst at Glassnode, and we're really kind of pioneering this world of Bitcoin on-chain analysis and really looking at the heartbeat of not only the network and the protocol itself, but also how investors interact with it. And Bitcoin is one of these fascinating and super organic. It's a thing. It's almost like an organism, but it has this digital footprint that it records every 10 minutes. And within those blocks, we can pull out investor decisions. We can see how the network is performing on a health perspective, but really looking at how coins move around the system, which is just it has been a fascinating field to really push into. Now, in terms of the multiplier effect, one of the most foundational metrics we have in the on-chain space is called the realized cap. And it's essentially an equivalent to the market cap, except we value every coin at the price when they last moved. And why this is really powerful is Satoshi's got 1 million or so coins, but they were moved last at a price of 0. So we effectively discount them. They're worth, 0 times 1 million is a 0. Early miners may have had a couple of cents, but if those coins are lost, and we've got this kind of pathway of coins saved at their last move price. Now, from a capital flow perspective, this is actually really powerful because when somebody acquires coins in a bear market, for example, and then sells them, at a 10x higher price, somebody else has to come in with more capital than the original purchase to actually take them off the market. And likewise, when people who buy, at the exact wrong time in the cycle have to sell coins at a lower price, there's a capital destruction. So what we're looking at with this realized cap is this kind of long, smooth change in capital inflows and outflows. So one framework we can look at things is that when coins are on exchanges and they're trading around, in many ways, they're kind of one button away from a buy and a sell. So they haven't quite entered that realized cap space. It's only when somebody actually does the withdrawal transaction, takes custody, or in the event of an ETF, because they're spot denominated and there is going to be this buying and selling on exchanges, and there'll be coins moving between different multi-sig wallets, a lot of these transactions will get recorded into Bitcoin's database itself. So coming back to that multiplier effect, we ran a study recently looking at how much does the realized cap change, essentially how much capital needs to flow into the chain itself to achieve a $1 change in the market cap. Now, this goes through a couple of different cycles. When we see, real euphoria bull markets, we tend to see that you need 80 cents, $1.20 of capital inflows to get a $1 change in the market cap. And from this perspective, it's starting to get into unsustainable territory, right? We're really, in terms of physics, you've got to put more energy in to achieve a smaller output. Now, as we go into bear markets and, interest wanes a little bit and you start seeing that there's more volatility, that number can drop to anywhere. Sometimes it gets down to 10 cents. So a 10-cent inflow or outflow, works in both directions, can produce a $1 change in the market cap, which really heightens that volatility as a result of lower liquidity. So it's just one framework we can look at things, but the long-term median is typically around 25 cents, 30 cents, somewhere in that ballpark. And where we are at the moment is in that range, 20 cents, 25 cents. So again, it's just trying to put a bit of a figure around things, but we're looking at somewhere on the order of about a 4 to 5x kind of range in terms of dollars in versus market cap change. And again, this is in both directions. It's a non-directional study, just basically looking at how much does that realized cap change per unit change in the market cap.
And how do you think an ETF approval might impact that dynamic, or what are you kind of looking at to see massive shifts in that price multiplier effect?
Yeah, I think that's a really good question. And I think the first thing, when I just kind of take a very objective look at things, the ETF, as we've discussed on this spaces, is just opening up a new level of demand vector, right? So Bitcoin's always had this, there's always been the halving and the debate around how much the halving has an impact. And that's a supply side shock. And people's narrative starts, people get excited about the halving and it's kind of a self-fulfilling prophecy. Whereas with the ETF, what we're seeing is opening up of the doors of just more people are able to come into this space. So for me as an on-chain analyst, it's constantly this game of how much does the on-chain data, because there's obviously trade activity, there's futures markets, there's spot markets, there's actual activity that's happening on the chain itself. How much do these speak to each other? And what I've always enjoyed is understanding those as almost statistically significant subsets of the market. The data we can extract from a futures market or a spot market or on chain, it typically represents a statistically significant subset of Bitcoin investors. And whilst their data may plot differently, open interest or spot volume or realized cap, when we actually reconcile these, we tend to see they're telling the same story, just with their data explained differently. So it's very much about, reconciling, seeing how markets move. One thing we do at Glassnode is we actually label entities so we can see, these are Coinbase or Binance or ETF A, B, and C. And we can actually look at those dynamics individually. So it may be that there's a result where we actually look at the realized cap including or excluding ETFs. It may be we look at only ETF flows. So we can actually start to really dive in and build out this data layer to understand how these flows impact that both interpretation and whether it actually does change things in our perspective. So one of those things where it's constantly evolving, which makes my job very exciting.
Well, and I know we have you on as well. Please introduce yourself, and if you have any thoughts on just the broader implications for the on-chain world as it relates to this Bitcoin ETF approval.
Hey, thanks for having me up. Sorry about any background noise. No, Checkmate was super throughout the Bitcoin community. It's the fact that 70% of the circulating Bitcoin supply hasn't moved in at least a year. So, if you kind of go back, where were we trading at a year ago? This is right after FTX went down and kind of the back half of all the credit contagion that took place throughout the bear market. And so, not only is that a pretty remarkable kind of standalone statistic, but, when you kind of add in the context of, where we were a year ago, I think it kind of makes it even more remarkable.
Sorry, Will, you cut out, but we may have lost you. We brought up that stat just in terms of long-term holder supply broadly. I mean, the way that we think about it, and for anyone interested in kind of learning more about on-chain analysis broadly, we publish a Bitcoin monthly spearheaded by our dedicated on-chain analyst, David Puella, who, I'm hoping we can get on as well. David, if you want to request just to kind of share a little bit of your insight as we speak about this, that would be awesome. At a high level, I think when you think about the fundamental framework by which to analyze Bitcoin, it's going to require an understanding of buyer and seller behavior. And the most sort of granular and succinct way to do that is through, on-chain data. And so the way that you can parse this data is you have, raw data that you've scraped by running a blockchain or a Bitcoin node that allows for you to assess the relative health of the network. So think things like hash rate as a proxy of network security, broader transaction volume, active addresses. And then you can sort of further manipulate that data to Check's point, measure sort of the cost basis through time, where you're able to basically timestamp every Bitcoin based on which they were last moved. And that allows for you to get an aggregate cost basis of the market. And in so doing, you're able to see sort of relative profits versus losses when you compare it to the market cap. So things like realized capitalization are a new phenomenon in understanding and analyzing Bitcoin as an asset. And then when you think about, one layer above that, what that does is that it provides an entirely new framework by which you can, even actively manage those assets. And that's something at ARK that we're, thinking about is we understand the underlying fundamentals. Are you able to translate those fundamentals into actual active management decisions? And so being able to sort of create, oscillators and fundamental metrics that allow for you to understand the relative valuation for Bitcoin is also it's a really interesting kind of dynamic that hasn't really existed in other asset classes because of our ability to see supply and demand so granular. Pump, I know that you jumped on as well. Happy to have you on. Would love your thoughts on this long awaited news that we finally seen a Bitcoin ETF announced. You've been obviously quite vocal about Bitcoin as a new asset class, sort of the institutional demand dynamics, and your thoughts on the implications of a Bitcoin ETF would be greatly appreciated here.
Hey everyone, cool to see so many people who've worked so hard on this. So congrats to all of you. I think that the ETF is going to be a blessing and a curse, which is kind of a unique way to look at it. But I think this really marks kind of a moment where Bitcoin has now fought for 15 years to be accepted, right? You kind of put that in air quotes, whatever that means in traditional finance. And now that it is accepted, there's many of the things that maybe were attractive about it previously that they're not going to go away, but they may just become a little bit less important. And, kind of the best example is a lot of people were attracted to Bitcoin because financial advisors or others weren't interested in it, right? It was kind of a counterculture, et cetera. I think now we're going to see, Wall Street's might and power. And my expectation is that this will become an asset that's in everyone's portfolio. When you do that, obviously, returns, correlations, a lot of things change. I don't know if we have enough information today to really predict exactly how that's going to change. We can look at other assets, but I think that this is like this really important moment where essentially now Bitcoin has, Wall Street opened its arms, hugged the asset, going to pull it into these portfolios. And that's probably great for price over the long run. But I also think that investors are going to have to pay attention, right? The ground is kind of shifting now. The holder base is going to expand as it has in the past. And so it's going to be fun to watch. Like every time that we've seen this happen and kind of gone through these different paradigm shifts, if you will, I think that everyone learns something, but also it's kind of what is intellectually stimulating about an asset like this.
Pump, this is Kathy. One of the things as we've been talking, we've noticed, especially in the last 2 years since interest rates have started going up, bank deposits have been going down. Money has shifted towards brokerage houses and their money market funds that were yielding much higher than bank accounts were. So all of this cash has built up in the system, and cash levels, I think money market funds are over $1 trillion now, something like that, with this accelerated shift into them. And now it's housed very often in the brokerage houses, the wirehouses, as cash effectively. So, and we know they need to put some of this to work. There's been incredible risk aversion in the markets. That's why the equity market had such a big year last year. People were stunned that it could do anything at all. So I'm just throwing that out there because I think they need to do something with the cash. They have to earn their keep. And I do think this is going to be one of the ways. What do you think?
I could not agree more. Actually, something that Will and I have talked quite a bit about, and I've written a piece and deleted it about 4 times because, frankly, don't know if I'm good enough to articulate it yet. So I apologize in advance. But if you really think about the stock market, so forget Bitcoin for a second, but just equities in general, there's a pretty strong argument that past value metrics will underpredict or undercount the true value of a business today because of this thing that you're talking about, Kathy, where there has to be some sort of monetary premium, right? When people are aware of inflation and they're getting out of cash and they're literally buying equities as an escape or as an insulation from some of these forces, that changes, right? That changes the way that you think about valuations. It changes the way that you think about allocating capital. That changes the way that you think about what sectors even to allocate to. And so I've always thought of Bitcoin as kind of the truest free market asset that we have. And so it kind of takes that idea and really brings it to the extreme. But really, the ETF, I think now is a signal of what used to be considered an extreme idea is not really that extreme. And another way that I think about it is if you were to ask somebody in the 1980s, 1990s, even probably into the 2000s and early 2010s, what is your benchmark? They would point to the S&P 500, maybe the Qs or something like that. Now, when I talk to people in their 20s, they tell me that their benchmark is Bitcoin.
You know,
Mhm.
well, can I beat Bitcoin? Well, the asset was up 150%, 170% in the last year. And so it's just very hard to do. And so I think that's another thing is like, is there something happening where people are saying, I'm not going to allocate to the S&P, why would I only want 10%? In a world of easy money, I need more. And so they start using Bitcoin as that benchmark. And that just, again, holds value for a long time. It's sticky capital. They look at it as an index almost. And that would be a really big tailwind for Bitcoin, obviously, if that continued as a trend.
Well, and the intergenerational wealth transfer from baby boomers is accelerating now. So what the trend you're talking about is probably going to accelerate.
For sure.
Perhaps I'll just jump in and flag the central research piece that ARG had for 2023. It's called Quantum Economics, developed with Checkmate since I have it here. Perhaps, Check, we can discuss a little bit of what we implemented there and the ideas we discussed on that topic. I guess we already talked about how Bitcoin can be price stamped to some extent. Perhaps we can discuss how it could be time stamped as well. And we can take the holding behavior and the holding time of different investors at different times and get a sense of how dormant or how active the network is in a general sense.
Yeah, absolutely. And I mean, this coin-time economics was kind of an idea that just spawned off one of Dave's. Dave had an idea when we were in Mexico, and it just morphed into this framework of how we can actually rethink analyzing Bitcoin, but also understanding its heartbeat. And as Dave mentioned, there's kind of two real key components in the world of on-chain analysis that either doesn't exist or is very hard to replicate for traditional finance. And that is the price stamping. So every single unit in the supply, we can price stamp at the time when it moved. But as Dave mentioned, we can also time stamp it. And the problem that we set out to solve was that many of our valuation metrics, even in the on-chain analysis space, they still include all of Satoshi's and the lost coins. So another way to think about this, as the market moves and is volatile and we go through, boom and bust cycles, there's a large swathe of coins that simply don't respond, can't respond. They're lost. The keys actually cannot bring those coins back online. Now, despite that fact, most of our on-chain valuation metrics still dilute. And they basically say that those are still circulating, right? We use circulating supply. And the question we tried to set out was, how can we actually build a robust framework that can, more or less discount coins based on how long they've been dormant? And this comes off the back of some work we did at Glassnode, where the longer that a coin is dormant on chain, the more likely it is to stay dormant. Another way to think about this, if you were to withdraw your coin from an exchange tomorrow and you just unfortunately lose the keys, you're the only person in the world that knows those coins are lost. The market cannot discount those as lost. They're going to see them as still liquid and able to migrate back into the space on any volatility. But let's say those coins are dormant for 3 years, 5 years, 10 years. The longer those coins are dormant, the higher our probability curve goes up that they may in fact be lost. So what coin time economics does, it uses a really foundational metric of time, which is the coin day, which is actually one of the first Bitcoin on-chain metrics. It's literally how many coins are held and how long in days they've been held for that period of time. And the probability goes up that they're lost the more coin days these coins accumulate. But conversely, when a coin is spent, let's say coins accumulated in the previous bear market, they sit there for 3 years, they've accumulated a large time economic weight. They've got a lot of coin days stored within them. So when that investor or that cohort of investors who've got those 2, 3, 4-year-old coins, we typically see these folks come back into the market and start spending when it's opportune, right? The market is rally. They're seeing, large percentage gains. So we've historically seen large expulsion of coin days, which we call coin day destruction. So this is economic information. We're basically looking at when those coins come back into the fold and they re-enter circulation. And what coin time economics does, it's a framework to actually create a discounting curve, and it bifurcates the supply into vaulted and active. And the way to think about this, vaulted is kind of the most dense coins that just simply don't want to move. We actually don't need to measure which coins they are. It doesn't matter if they're Satoshi's or if they're somebody else's that was lost yesterday. It's a really nice, simple mathematical framework. We can just say they're either lost or they're mobile. And, one of the, Dave, I might pass this back over to you, but one of the really powerful things that we got out of this is we found this pricing model called the true market mean, pretty much exactly and always has been in the middle of Bitcoin as a long-term mean and median of 1. And this is one of Dave's inventions. So I'll pass it over to him, but it's just these new valuation frameworks with mathematical rigor behind them that I think is just pushing the asset forward.
Yeah, I think that's a good segue to plugging our research. If listeners want to find out a little bit more on what the true market mean, how it works, its formula, and its mechanisms, we recommend going into our website, both the Coin Time piece that we have published since about 6-7 months ago, and the Bitcoin Monthly that comes out every month, few days after close.
Yeah, that white paper is available, and I think the invention or the heuristic of the coin block check is not to be underestimated. You're basically implying that there's now this fungible unit of measurement in Bitcoin's economy that allows us to even better assess the economic state. And I think as for, those who are just trying to understand Bitcoin and trying to understand the fundamentals, these are the kind of metrics that you want to be looking at. I want to also maybe just quickly, as we wrap this up, Ophelia and Hani, I know that 21 Shares is also doing a lot of research. Where can we find the research at 21 Shares? Analytics has been a huge help that you guys have used.
Yeah, Dune is great. We are now the number one team on Dune as of now. So if you go to dune.com and you can search dashboards, you'll see a bunch of them that were created by us. In addition to that, I would invite everyone to go to 21shares.com/research for all of our reports, as well as at 21shares_US if you want to follow our updates and our researchers on Twitter.
Fantastic. Kathy, any closing remarks on this momentous day? And I think, again, talking about this in the context of where ARK has come and where it plans to go is a great way to top this all off.
Oh my gosh. Yes, thank you, Yassine. We are so happy to be live with all of you in the community today as we received word, literally it was when this space has started, that a spot Bitcoin ETF, or that ours was approved and effective. And we're really excited to see ARKB start trading. So that's the ARK 21 Shares Bitcoin ETF. It's launching tomorrow. I want to thank you all for joining this conversation. You have added new dimensions to many people's understanding of Bitcoin. I think we got into some really nice depth, and we've been honored that you're on this journey with us, and we're on the journey with you. We are part of the community, and we do feel so welcome. We want to thank you all. We especially want to thank our speakers. I thank you, Yassine and Rod, for pulling this together. A special shout out to Elon for, being with us, sharing a moment with us, and for this amazing place called Spaces. So thanks again. And we're looking forward to doing more of these in the future and sharing more and more time together. And you can direct people to ARK.com if they want to learn of any details about ARKB. So thanks again, everyone.
And I believe we'll also be doing a YouTube live as well tomorrow. So stay tuned for that.
Thank you. Thank you, Yassine. Yes, YouTube live. And it's at 10 a.m. And I think that's going to be our debut also on TikTok.
Another question I didn't get in before was, have you seen any interest from public market companies like MicroStrategy to use the ETF, given its fee structure? Because it might be simpler. There weren't that many companies following on to MicroStrategy. And with this fee structure, it might actually be more efficient for them to just buy the ETF.
Tom, if you're on, this is something we've been thinking about a lot, just the benefits of an ETF relative to spot.
Yeah, this goes back to the comment that we've talked to investors of all shapes and sizes. So, I can tell you for certain, we have had very concrete conversations with public pension plans, with state treasuries, stream interests. The same is true on the corporate side as well. I think that some will have a learning curve. Some have put Bitcoin on a balance sheet directly. Some are just kind of waking up to this, and or their board said, don't bring this back to us until it has a regulator signing off on it so that, we ourselves can point towards that. The answer is yes. We've had lots of conversations in really all of these different shapes. I think that if you think about a company that has Bitcoin on its balance sheet in any way, shape, or form right now, if you're a company, public or private, or distinctly private of scale, this has a lot of advantages for you because you're bringing assets back under your banking relationships. We all know these companies, whether they're public or private, have a great need for strong banking relationships, whether that's to, issue more bonds, whether that's to go public, whether that's, borrowing and debt financing. And, the size of the relationship has a direct impact on what they're able to do, the fees they're able to secure them at, the interest and the efforts and the enthusiasm of underwriters. And so, there's also, you also start to look at financial statement impacts, whether that hits, different parts of the income statement and balance sheet as there's a transition going on, but we're not fully there, and the benefits certainly do accrue towards these securities. So absolutely, we expect to talk starting tomorrow, really with all sorts of companies, and we're really excited about that. Again, just put a final bow on this so that we'll let people go. But Beat starts tomorrow. It starts trading at the beginning of the trading day. It's listed on the CBOE exchange. Again, the ticker ARKB, and we're really proud of that. And again, just to echo what everybody else has said, thank you to everyone for joining us. Thank you for the guests. Thank you for the speakers. Thank you for your support, whether that's an investment that's coming or whether that's just simply encouraging the research ecosystem, consuming this content. We're very grateful for you and for many more interactions to come.
And just one last thing, Adam, to answer your question about MicroStrategy. Michael Saylor had a conflict. We invited him to join us. He had a conflict, but he is hoping to join us on another Spaces so that perhaps he can answer the question in person, so to speak.
Great, thanks.
Okay. All right. Thanks, everyone.
Thanks, everybody.
Thank you.